Good morning, everybody. Welcome to Series 3, Episode 3 of Crystal's Complex Cases. I'm John Morris, Key Account Director, and we are joined, obviously, by the one and only tax wizard, John McCaffery from Alexander & Co. As everybody knows, he's the main showcase and main event of this series. And I'm also joined by Roger Morris, who needs, again, no introduction. Obviously, things are done a little bit differently today. This is his Father's Day gift from me. Gets to spend a bit of time with me, obviously work-related. But yeah, we're mixing it up. So sharing the same screen, cutting back on electricity and cost, because that seems to be what the world's about at the moment. But yeah, in terms of format today, so it's going to be, as most of you know, just a general freestyle format. Any questions that you got, please do ask. I'm sure there's going to be loads flooding in as normal. The content's going to be driven by you guys. We have pre-asked questions in already, so thank you very much for those. Obviously, at the moment, the market is and has continued to be in an interesting state. Certainly over the past 12 months, it keeps, well, peaking and troughing really, doesn't it? But it's no surprise to us. But we get through. We're here to ask any questions and answer any questions from a broker point of view. So I'm sat with you guys fighting your corner. We've got a lender on, obviously, so please do ask all sorts of wonderful questions about rates, swap rates, where the market's going, market trends. Roger will hopefully look into his crystal ball and give us a bit more insight and comfort as to why things are happening and what is happening and the reasons behind that. And then John is obviously here to answer, well, not just tax related stuff, he pitches in with everything. So yeah, thank you very much for joining, gents, and thank you everybody in the audience for continuing to support us. So first and foremost, how are you guys and how is business? Because again, a lot has changed in the past 2 months. So let's touch on the past 2 months and then the year moving forward. So how's it been, Rog?
A lot has changed, and my thoughts and priorities are with the brokers out there that really serve all lenders. We've seen now the biggest increase in advice where lenders can no longer give customers advice in a safe way. So I think we're around about 90 to 92% of all mortgage advice now through the intermediary. And how do you think lenders are repaying that loyalty and that much needed business when it comes to pulling products? I just think lenders are very poor in pulling products with maybe an hour or 2 hours notice. But I think we'll get into that more detail later on, Dan, as a proper question. So certainly what's happening within interest rates and swap rates, and what does the future hold for the buy-to-let sector? So part of this session today, we're going to grill John a little bit from a tax advice of what a landlord can do at the moment with the ever-increasing interest rates, and what will the Bank of England do on Thursday, though with inflation coming at 8.7, remaining static today, it's already built into 5-year swaps. So regardless what the Bank of England do or don't do, if they don't act, then sterling will drop, but rates will go up regardless. And then, John, I actually think might not be a bad idea the next time we do this. We actually came to your offices and we actually did it as a team, and then do a further insight of what really is a tax advisor and why brokers should have those relationships. But anyway, what's your summary of the market at the moment, John?
The market at the moment, I mean, I'm still busy. All professionals I know are still busy. It's not necessarily just from the property market, though. There is still a lot of property work going on out there. I'm getting more inquiries about limited companies, as you might imagine, because the interest rates do mean that those who are finding themselves in the high rate tax bracket may actually be paying more in tax than they are getting in rent profits. So yeah, interesting times. Really busy though. Still really busy. There isn't the slowdown coming that has been much touted, and apparently that's part of the problem. I've been speaking or listening to a couple of economists, and it's the fact that we are still, as an economy, doing okay, and people are still spending, which means that inflation is still up, and as a result, interest rates are following to try and suck funds out of the economy.
Yeah, no, absolutely. And from our side of things, we we're busier than ever. So front end, we're busier than ever on new business coming from existing sources and the new relationships, which is amazing. And to be honest, it's kind of expected really, because if you're not or haven't been in the specialist market, which is ultimately the only market that we are active in across the board for all sectors, so to speak, people are coming to us for more of a hand-holding exercise, because as I keep banging the drum, and probably said this on the last episode of this, if you want to maintain your income that you earned last year, or even look to grow your income this year, then you're going to have to diversify your business streams. It's as simple as that. So the standard model of vanilla residential and buy to let, with the markets drying up on these product types and areas, then it's where do you get your next meal from, or where do you surplus that income? And ultimately it's in the commercial space, the bridging space, development space, second charges, which are massive this year, which I'm sure we'll touch on in a minute. But yeah, we're busy now at front end. It's just frustrating with obviously all these lender pulls and knee-jerk reactions within the market, whether they're right or wrong, but that is impacting obviously the back end of stuff. But we're dead well equipped in terms of handling these cases, finding homes for these cases, and even finding new homes for the cases if the products are pulled at short notice. So one thing I will stress to everybody on the call, certainly from a broker perspective, if you're not teaming up with someone like ourselves, it doesn't have to be us, but a package within the marketplace, then I think you should do, because for me, more than anything at the moment, it's about the people that you surround yourself with. It's about your allies and who you can work with and rely on. So yeah, that's the main takeaway from me at the moment. The market's getting more turbulent, and it's just equipping yourself with that fourth emergency service, which a packager is. Not quite as important as fire, police and ambulance, but we're there to serve a purpose.
That's why you're fourth.
Exactly that, not fifth. But yeah, so no, that's, I suppose, a good overview, and everyone's singing on the same page. And again, it is an interesting time at the moment. But I suppose let's jump into the first pre-asked question. So, Rog, as we continue to see volatility with swap rates, how does this continue to impact your lending strategy, and what do you envision the longer term impact on mortgage product pricing? Now, before you answer that question, and I can re-ask it again in a second if you forget, so I know you're getting on now. Let's discuss swaps. So where they've been, where they're going, and how that affects lenders' pricing within the marketplace. I appreciate a lot of people are now looking at swaps on a daily, hourly basis, so to speak, but how does that impact mortgage pricing, and why are lenders so quick to pull products when swap rates do obviously go crazy?
Yeah, I guys, at the moment, my commitment, and we put this in social media. We sent out an email today, so anybody who's registered with Tandem Bank will be constant reminders that we give 24 hours as a minimum to advise you with pulling rates, ideally 48 hours. So you've got between 48 and 24 hours to do that dip. And as long as that dip has passed and it didn't need to go to refer, and you got your ESIS, we then give you 7 days to get that application in. Now, we're not the only lender to do this. There is other lenders out there. But when we look, and I'm constantly on the Chatham Financial, I'm just on a look now just to see where Sonia swaps are. And at the moment, where it's pitching at the moment is a little bit down from the last couple of days, but I think you're looking just under the 5% rate. So regardless what the Bank of England do, if the Bank of England don't put interest rates up on Thursday, then sterling will devalue and inflation will go up, because we're so reliant specifically on food for imports. But when it comes to logic and common sense, we know swap rates have gone up. So lenders will see swap rates have gone up. They'll have teams, they'll have people. If you're in charge, you should be aware of this. So if I'm about to today hold a meeting on whether or not I change rates, it needs to be straight away. But what's wrong in communicating out to you guys that, look, we know rates are going up, we know we're going to have to pull rates, and we know we're going to have to put them up. Why can't we put you on notice to say, look, we're reviewing rates today, anticipate them to be pulled? What's wrong with that? That's what we do, Dan. And I think the reason with all these big institutions, Rob Sinclair had the top 6 in, and it's literally, they're all too busy. They've all got their own priorities, but you know what isn't a priority, Dan? It's not the intermediaries. You are not the lenders that you serve their priority. And they'll say, oh, we just get flooded, we just get taken out because we're number one. They've known this, but it's just their inability to treat you with equal respect. And I think when it comes to that point of letting you have enough notice, and how many times with certain very large lenders, will you be logged on till 8 o'clock at night and literally you're just about to get through and you're dropped. And you're going to go back in and you're suddenly 3,500 in the queue, and then you get to 10 o'clock and then you've lost it. And you've been on that all day. So all day you've been on a certain volumetric lenders doing the right thing for your customer. I know one of your brokers in Crystal were, Dan, all day.
Well, there was a certain lender last week, not to mention names, which were pulling the rates at 5 o'clock. They got too busy and pulled them at 2:30, didn't they? So without any notice. So again, for me, in the lender space, I mean, this is never going to happen, but there should be a group communication. We're going to look to review rates and change rates and all do it simultaneously, because I get why people price themselves out the market or exit the market, and then the top lender goes, the second lender goes, and instantly, if you were the sixth lender in that queue in terms of rate and pricing, you're then number one, you're inundated. So it just creates this dominoes effect of lenders. But I think it could be done a lot better. And we've had a year now to practice this in terms of having these discussions and collectively pricing at the same time, or increasing whatever at the same time. But as you say, there's obviously a different agenda there, and it's not customer centric at all. So yeah, and I get with the lenders that are funded by securitization in the markets, in terms of you can't lend it out for less than what you're getting it in for, because that's not a business model which is going to be sustainable. And it's obviously a loss leader. So I understand that. It just could be done differently and done better from our point of view. So yeah, but no, thank you for your clarification. And hopefully you'll be leading the market in terms of how you let people know and giving people time to get them in.
Well, anybody who's, just as a final point, that if you're registered with Tandem, we will send out a notification at least 24 hours before we pull. We send that to our distribution, our networks and our clubs. But following on from Dan's question, as rates rise, specifically in residential, affordability becomes virtually impossible. And where people who've maybe put a deposit down on a new build, got an offer, but for whatever reason that build was significantly delayed, you may have to go back and you may have to then refinance your deal, and you might not even pass affordability. Is, to me, is just awful. And then secondly, at what point we're going to go to a base rate of 5, and people, I remember when Dan was born, we moved to a new house. He was 6 months old and the interest rate was 15%. And people say, yeah, but we survived 15%. 15% is actually lower in monthly expenditure than 5% now. And that's because of the value of a typical mortgage and typical loan. If you actually work it out, you know, then a property, an average property was around 50 grand, 65, 70 grand, where you compare that now to the average earnings, it was more impactful now than it was then. And then, so it's about, lenders are going to also have to be concerned about the value of their security. So there's always this nonsense talk that property prices will drop. It's so easy just to get news coverage. We had it in the 90s with negative ec. That was literally very short-term lived, and it only hit specifically the southeast of England, which is all the press concern. It didn't happen in the vast majority of the country. So there's always a concern property prices can go down, but with the fact that we're taking in 400,000 new people into the country every year and building less than 200,000 homes, property prices remain stable. But the last point, which is a seamless link to John, is as interest rates rise, and we've moved from buy-to-let's average 5-year fixes at 3 to about what, 6.5%. And those landlords that never took the advice of going into a limited company from 2016 because they thought the rate, a 3% rate in personal, was cheaper than a 4% in limited company, and not understanding the net income position, must be now thinking, I wish I'd done a limited company. So John, if I've got buy-to-lets in my own name, I'm now suddenly being offered a 6% rate or a 5% rate, but the ICR doesn't fit because the rent's not the same. What about options like a lender will offer a 5 or a 6% lender fee added to the loan and offer a much cheaper 5-year fix to make the affordability fit? What's your view on that, John? And what's your view altogether for what you could do for buy-to-let to try and withstand these next few years?
It's in my game, it still comes down to what are the individual circumstances, and those individual circumstances are obviously going to be affected by rate of interest and affordability and ultimately available cash. And it's what you can afford. Some people might be in the position whereby they can weather this. Some people might be in a position whereby they can afford to get the properties into a limited company. Some people may have to sell. But there are tax costs to all of that. So you're holding the properties in your own name, the interest rates are increasing. If you're a basic rate taxpayer, you're getting full tax relief. If you're a basic rate taxpayer, when you bring your rental income turnover in, you're still getting full tax relief. It's just, your interest is costing you more, so you're actually seeing a lower net profit. If you're a higher rate taxpayer and you've got the properties in your own name, you're only still getting 20% tax relief, but now you've got a larger interest cost. So whilst you may be getting 20% of a bigger figure, you're having to pay out a sizable amount more in interest. So the question then is, right, do we get the properties into a limited company? Okay. We've talked about this a lot. There are a number of tax considerations about getting your properties into a limited company. If you are transferring from an established partnership and it's been established for a while, you may be able to avoid the stamp duty land tax cost. If you're not, the limited company will pay stamp duty land tax inclusive of the 3% if we're looking at residential property. You may be able to avoid the capital gains tax on the transfer into the company if you have a property business, which means you're actively working in the business, doing approximately 20 hours a week on that business. If you can't, you've potentially got your capital gains tax to pay, which we know is 18% for a basic rate taxpayer and 28% for a higher rate taxpayer. That may not be the end of the world if you can afford it, or you can, and I know rates aren't great, but if you can leverage up the properties in the company, because that gives you potentially a loan. So you transfer the properties into the company owes you the value of the equity. Yeah. So you may then have a loan you can draw down on tax-free over a number of years, which might help your tax position. It may be you've overextended, given the new interest rates, you haven't got a lot of equity in the properties and you have to sell. The worst of those scenarios is you have to sell and you have to pay your capital gains tax, because a sale of a property is still subject to capital gains tax. Price you sell at, less the original cost and all the enhancement expenditure and that kind of thing. But you have to take stock of your situation and work out what the best answer for you in the circumstances. It's just the same. It's just as the advice has always been. It's just that the external factors have changed, and your options for some people may be a bit more painful. For others, this is a world of opportunity, as they are getting to basically hoover up fire sale properties.
John, I think you just one point I want to come on before Dan says was, I've just gone through a repossession. It was an awful situation. The tenant was lovely. It was a divorce. They stopped paying last October. The tenant just kept apologising for the situation they put us in. The local authority have told them not to leave the property, to go through the courts. The courts are in absolute shambles at the moment. Apparently sending out documents for our representative to turn up in court. That never happened. It would be anticipated at the moment at least 12 months to evict. So if you know today that your property is losing money, if you decide to sell, or your tenant stops paying and they know how to play the game, it could be between 12 and 18 months. And if you've got a shortfall of £500-600 a month, and then you've got to take possession of the property, you've got to make sure the property's in a relatively decent repair. That could take you a couple of months just to tidy it up, maybe do some improvements. And then the length of time to sell, even though you make the decision today to sell, John, it could be 18 months before you've got rid of that millstone around your neck. And I actually think at this moment in time, there's a significant amount of landlords who are high rate taxpayers who own property, highly geared, where the rent returns are just not there, are really under an awful lot of a stress situation of what to do. So if I'm a landlord or I'm a broker today and I'm really in that situation, surely it must be worth a one-off fee to someone like yourself, John, to say, look, let me investigate all the options, and then that way at least you know in your own mind the only option is to sell or a way through this, because you've got the broker there for the financial advice and what the rates are. Nobody can guess. And then I think, Dan, this is maybe even something Crystal could do in a conversation to give that support of what options are there on funding. But what would you say? Because you deal with lenders that will have higher fees. And I know there's a lot of brokers specifically in London have had the best year by doing these, because at least it gives them 5 years to do a controlled sale, which again hasn't to be ignored. Is it better off paying extra money and not having to go into arrears and a negative credit file? So we've got to look at it from all angles. Like, if I'm losing 500 quid a month, I don't have £500 a month spare, I'm going to go into arrears. It's going to take me ages to sell, or I could get a fixed rate that I can afford, but there's a large fee. You've got access to all these lenders. What's your view? What you're seeing? What would you not advise but recommend?
It's a tough one, really, because I mean, from a mortgage broker's point of view at the moment, for the past 15 years, it's been, do you want a fixed rate or do you want a longer fixed rate? It's kind of been as simple as that. But with all these new products coming in the marketplace, whether it's fixed rates, variable rates, discount, tracker, fixed rates with larger fees, as you just mentioned there's so much now that we need to evaluate and look at the costings on. So it's not as simple as what I would advise. I think it's a case of actually looking at the overall picture of that particular transaction or client's finances, scenario, portfolio, etc., and then putting the plan in place from there. So sometimes it works, sometimes it doesn't. It really depends on that client's position, the values, lending amount, etc. So it's not similar to what John does. It's not a one size fits all. It's just finding that best solution. But again, we can navigate the lenders' products that are available and find that best solution for the client ultimately. Just going back to a couple of points that you mentioned previously there. So, John, this is going to be a question for you, but we've seen an increase in landlords 55 plus that are just thinking, can't be asked anymore. The cost of materials is increasing, rates are increasing, the yield's not there. Actually, I'm losing money on this property now. I'm not making enough income to make it justifiable to have the headaches of having management properties. Obviously, for our friends up in Scotland, there's a rental lock cap, whatever you want to call it, where they can't increase the rental up there. So actually they're in a far worse position than what we are in England, so to speak. But we have seen an increase in over 55s that are taking the CGT hit and just selling up because they're just not interested in the marketplace anymore. How does that compare to what you're seeing at the moment in that marketplace for people just selling up the portfolios, certainly with the pending EPC changes coming in now 28? How does that sit with you and what you're seeing and advising clients to do?
Bizarrely, I am still seeing clients who are interested in property portfolios and buying into them. There is a lot more interest in limited company structures and starting off in a limited company structure rather than buying one or two buy-to-let portfolios. I'm not seeing a lot of people exiting the market. The reason for that, probably, and I understand what Roger was saying before, is if somebody's in a financially distressed situation and can't afford that 500 quid a month, right, they're not incurring the fees on an advisor. They're not adding to their costs. I understand that. It could ultimately help them, but I do understand that. As a result, I am still seeing those making money in the property market at the moment.
Can I just say, I don't think there's a better time to be in it, John.
Yeah.
But what I do see is those brokers who've advised customers about a limited company.
Yeah.
The landlord in 2017 didn't see the value, looked at the headline rate, didn't understand net profit.
Yeah.
Has one or two properties, reasonably highly geared, and literally now is making a loss and is getting out. But for landlords who've got properties like I have in limited companies, relatively lowly geared, in areas where tenants look after the property and you have huge demand, you know, when this property we've repossessed, which has been refurbished, those that follow me on social media seen I've been doing it myself, most of it. When that comes back on, I'll have at least 30 families. So I don't think you can ever get a better time. And remember, of the 4.8 million buy-to-lets, 62%, John, have no debt. So they're not really affected by that. I don't think there's a better time to be in it, but I do, and we will sell off some of our cheaper northern properties where the tenants don't look after it. And so if you sell one and take that cash out and reduce the mortgage on another one, you kind of protect yourself in areas. But I would be very wary of the yields in the north being 9% when you look at the annual maintenance costs of those properties compared to Midlands of London. I do think certain areas of the country, the tenants are very dysfunctional in the maintenance of the properties, John. But I also worry if you're a single mother gone through an awful divorce, got 2 kids and picked up some adverse, you'll never get a rental property because the letting agents will just not let those customers pass. Every tenant I've had in my properties over the last 2 years have had to have a guarantor, everyone, and they've got really good incomes, John. So I do worry about the state of the buy-let arena for the next few years, but it is very profitable if you've got the right structure and the right loan to value. Dan?
100%, 100%. And again, another question for John. So we're seeing an uplift in landlords that have a residential portfolio and they're now looking to diversify into the commercial space. Yeah. So pretty savvy landlords looking at these semi-commercial properties, so a flat above a restaurant, takeaway, laundry, whatever. But ultimately, it's not what they're used to doing, and they're also not dealing with the lenders that they're used to doing. So again, we are helping brokers navigate that market, but they are yielding far better from an income point of view, which is what it's all about. Because at the end of the day, if you're a landlord and you've got properties, it is a business. Yeah, it's not a charity; it's a business. So you want to earn as much money as possible, in theory, and have an asset that appreciates in value, in theory. And we're also seeing more of them going to the actual full commercial space, so buying commercial properties. And retaining those commercial properties, again, whether it's office blocks, it could be a warehouse, it could be a gym, anything like that. Now, if you are purchasing these commercial properties or properties that have a commercial element, is there any positives to that from a tax point of view, or any negative implications when you are dealing and owning these sorts of properties with a commercial title?
Yeah, I mean, it's a whole different tax regime. Basically, there's no restriction on your interest. So all your interest cost is fully deductible. Your capital gain is at standard rates, not the enhanced residential rates. So that's currently sitting at 10 or 20%. Your stamp duty land tax is generally flat. So if it's less than 150, it's 0%. Next 100,000 is at 2%, then it's a flat rate of 5% after that. That is the thing to watch with commercial property, because they can be VATable. So, and it's a really complicated area, a really, really complicated area. But basically, if you buy a property that has been opted to tax, which means you have to charge VAT on it. And the reason people do that is that the previous owner will have incurred significant amounts of costs on the property, and they wanted to recover that VAT.
Yeah.
So as a result, when they sell it, they need to charge it. Sometimes they don't if it comes tenanted and you take on the same tenant or carry on the same business. But you may have to suffer VAT on the purchase of a property, and you will suffer stamp duty, land tax on the VAT. So that's the main issue with certain commercial properties. The other real benefit to commercial properties is you can release funds from your pension to purchase commercial property. So there's a lot of upside. There's an awful lot of upside to commercial property over residential property. It's all driven by politics. There's a housing shortage in the country. Landlords are not a class of voters people mind upsetting because they don't have a great deal of influence over the wider voter pool. And it's easy money to be made. So the idea from 2016 was to free up housing stock, purely to free up housing stock, because we haven't got enough housing stock, and now it's biting hard.
But John, two questions on that. One, I am seeing if I sell off a low value property, it does sell very, very quickly.
Yes.
And it sells to first time buyers. I'm talking in the northeast of England.
Yeah.
And there will be some correction in the south. But I did a big broker training session yesterday on buy-to-let in St. Neots. And the general view from the audience is the government is very much aware of the tax implications on landlords, that landlords are selling off. And do I think the government will reverse the interest release calculation for privately owned buy-to-lets? What's your opinion?
No, they won't.
Agree?
Absolutely won't.
It's not going to win any votes. Not for the Tories. It wouldn't do for Labour.
It's there is a little bit of a misconception about wealth in this country.
Yeah.
As those who have perceived wealth, it's deemed to be unfair.
Yeah.
Those your tenants.
Yeah.
I mean, I imagine it comes through in the buy-to-let legislation, which is becoming more and more onerous. There is a certain level of legislation required to make sure your tenants are safe and well looked after. And then there is additional legislation that just makes it difficult for the owner, but because it's a vote winner, to go for the, I can't phrase this properly, the perceived victim in the circumstance. It's with tax. It's if you are perceived to be wealthy, your shoulders are deemed to be broad enough to carry a tax burden. Yeah. But actually, after that tax burden, you're not particularly wealthy.
And what's the risk, John? It was when the 1988 Housing Act came in, it was revolutionary. Thatcher introduced that. Prior to that coming in, people rented in squalor because they had the ability to live in that property forever, no increase in rent. So the landlord left them in squalor because there was no upside. The right of eviction and the creation of the AST transformed private rental housing in the country to have the highest satisfaction rate now over local authority. By the reversal of this, suddenly now means you either will only put the elite tenants in who have got impeccable financial returns, or you'll decide to sell. So we'll have to see on that one, John, because I think it's a negative. I've just got a question in from Dan. And this comes from Ryan. Dan, I've seen a massive increase in regulated bridging, specifically for people downsizing. Literally, all the packages and brokers that Ryan knows has seen a real big increase, and this doesn't seem to be slowing down. If I wanted to get into this space more as a broker, this is what Ryan's asking, how could I do it? And what level of involvement do I need? And how can I then work in true partnership with Crystal?
Yes, I mean, the bridging market at the moment is booming. So we've seen a massive, massive uplift in terms of the business that we're receiving for bridging and finance. Now, if you look at 12 months ago, there was quite a difference in terms of the bridging rates, a lot higher than your standard term loan products. But as the years progress, obviously swaps have gone crazy, rates have gone up, base rates flown up. The actual difference between bridging finance, short-term finance, or term loans is negligible now. So it's actually looking more appealing and more favourable. So on the first and foremost non-regulated side, so buy-to-let investment side, we're seeing a lot more of these landlords, investors, whatever, purchasing properties via bridging finance, getting it on a 12-month term, and then seeing where the market goes, because they might believe that the market's going to drop and rates are going to settle and stabilise, so to speak. So they're purchasing it via a bridge, getting it done quickly, and then in a couple of months' time, assessing the market and then making their decision to fix or to reassess what they're going to do. On the residential side of things, again, it's been something that's been pretty common since COVID. What makes you wealthy, or what people feel makes them wealthy these days, is health. Now, it's not about how much money they've got in the bank or ultimately how much the property is worth. It's a case of their personal health and the family, because ultimately we all get buried in a box, don't we? Not to be a bit morbid, but we all go in the same size box, and you can't take it with you. So we're seeing a lot more, for example, older clients that will live the other side of the country to the children, the grandchildren. They want to move closer to them to spend more and more time. You just moved away, so more and more time with them, but ultimately their property's taking longer to sell. So they found a dream bungalow around the corner from children and grandkids. They think, right, we're going to raise capital via bridging finance, move up to Scotland or wherever as quick as possible. Our house will sell within 12 months, we're sure of that, but we want to move quickly. And that's one reason, one of the main reasons we're seeing a lot of regulated bridging get sent across to us, because for them, it's time is more precious than actually the overall costings of the lending. But as mentioned, the actual costings of the lending at the moment is relatively similar from short-term to term loan mortgages. Or if they want to break a chain in the property, if it's an auction purchase, there's a million different reasons as to why you would use bridging finance. Generally speaking, it's time, and it's time critical, or the property couldn't be mortgageable. But in terms of getting involved in the bridging market, probably only 10% of brokers in the UK actually deal with bridging finance, certainly on a day-to-day basis or even monthly basis. Now, in terms of every aspect of our business, of bridging commercial development, resi, buy-to-let secured loans, it's probably the easiest part of specialist finance that I discuss on a daily basis. It's dead simple. What's the asset worth? How much do you want to lend? What's the exit? It's kind of as simple as that. Those three main questions which formulate the overall solution that's provided to that client. In terms of brokers' involvement, now on the non-regulated side of things, you can simply pass them cases across to us, name, number, email address, and we can run with it. On the regulated side, so if it's a residential property, then we will hold your hand. So we can't take it on a referral basis, but ultimately, if you send a case to us and go, I've got a residential regulated bridging loan, can you help me with it? We'll absolutely help you with it. We'll give you as much hand-holding, support and education around that transaction to make you feel like you're the expert. The client will believe you're the expert, and we'll get that deal across the line. And ultimately, it educates you within that marketplace. So when your next deal comes in, you know exactly what you're speaking around, because that's what we are strong on. Hence why we do these webinars. It's a case of not plugging our own businesses, certainly not too much anyway. Even there's okay. But it's more about educating the marketplace and giving back, so to speak. We get enough, all of us collectively get enough business in off the back of the other things that we do. It's more about adding value to you guys, because you take the time to come on to these webinars and listen to us three reprobates talk. But yeah, so it's, in terms of how much involvement they have, ultimately on the non-regulated stuff, it's how much involvement you want, and on the regulated stuff, we'll hold your hand throughout the full process. But once you've done one, I promise you'll realise it's dead easy, really user-friendly, and it's a lot more straightforward than your bread and butter business that you're doing on a daily basis. And the bridging market, like you say, is booming. You'll probably hear that there's a lot of bridging lenders that may be going bump at the moment, but that's just down to funding. We deal with a lot of very, very strong lenders that are here to stay. So yeah, but if you want to learn more about bridging, then please do get in touch. But it is certainly a growing market, similar to that of the second charge market in the commercial space, which ultimately, after doing a recent survey, it's areas which most people aren't involved in, but they are interested in getting involved in. So any support that we can give, just let us know. There's another question that came in, John, which is, again, it's back to the commercial part, and it's back to portfolios. So we're seeing more and more portfolios being sold off as a whole. However, they're actually selling the limited company that holds the portfolio.
Yeah.
So most lenders obviously won't do that because they don't understand it and don't want to get involved in it. We do deal with these sorts of transactions, and we do deal with limited company takeovers, purchases, whatever you want to call it. Now, it is more complex, and only the commercial lenders will do it because they're the only ones that understand it.
Mm-hmm.
What benefits or implications, again, do you have as an individual? Let's keep this as quick as possible as well, if we can. I know your answers don't take me too short term. But what are the pros and cons of actually taking over this limited company versus buying properties and setting up your own limited company?
Right. No, it does make sense. It does make sense. So you're buying a limited company rather than buying the properties themselves.
Yeah, so you're essentially going to be taking over as director shareholder and doing that. So, yeah.
Okay. You want the quick version?
Quick version, yeah.
Quick version. All right. So
it is
the quick
possible.
version is you save a small fortune in stamp duty, because on the purchase of shares, you're paying 0.5% stamp duty, whereas if you're purchasing the properties, you're paying the stamp duty land tax rate at the various tiered levels. Okay. The potential downside is if the company has purchased the properties, the company has the cost of the properties, right? If you sell the shares, people by and large only pay about 100 quid for the share capital of a company. So the whole of the amount of the funds you receive for the company is generally subject to capital gains tax without any relief for the costs you spent, because the costs are in the company, not belonging to you. However, you pay 20% tax on that rather than 28%. That'll do.
That'll do perfectly.
All right.
Perfectly. But again, it's just another avenue that some people haven't thought of. But no, that's perfect. That's perfect. Thank you very much for that. We've had another question just came in live, so I'm not complaining. But why are bridging rates standing more firm at the moment? There seems to be less increase in the short-term sector. Will they change eventually, be much higher?
That's I was heavily involved with this one when I was at Precise and watching what Precise and UTB, which are definitely two of the forerunners within this. When you actually look at some of the pricing in bridging, has really got to some incredible low levels. I think was it the lowest was like 0.37 at one point, Dan?
Yeah.
And it literally, I won't say it was a race for the bottom, but it became the most intense area. It was about competition. So people wanting to get in and how to get in. The way to stand out in bridging market was to have the cheapest rates in reality. What you have seen is you've seen UTB and Precise recently move rate moves. And that predominantly is for two reasons. One, to try and stem volume flows, which is quite unusual in bridging. First time I've seen it in a lot of years. But two, might as well maximize on making a bigger return. I would expect to see some more slight increases, but because this asset and the way it's structured and funded, pending if it's reg or it's non-reg, has such a competitive streak to it now in this marketplace, I don't think we're going to see much increase in rates at the moment. I really think it will hold quite fast, which can give a landlord some real options. We do it on Tandem Bespoke, our high net worth division. You know, we're quite happy doing a deal for 2 years, knowing that the client is going to sell it. And the rates that we'll offer are like in the early 6s. It's for the super rich. You know, you've got to meet the high net worth divisions, and it's for those big trophy properties. But the returns on that specific loan, we know isn't going to be on the books for too long. We know there's an exit. We know what it is, and we're quite happy with it. But I don't see rates rising, Dan.
I don't, because again, it's all going to be linked to how the lenders are funded. Because obviously, if you've got correct me if I'm wrong on this, but if you've got a 5-year fix, obviously you've got the swaps market. Now, if you're lending out now at say 3% and swaps go up to 10%, then you are essentially not making money on that loan, and it is a longer term product. There's not as much risk because obviously most bridging is repaid within 12 months, if not a lot quicker. So even if you're lending out now at the current rates and swaps do decide to just skyrocket for whatever reason, you're not going to have a loss, or certainly a big enough loss. So with that, lenders on short-term funding, because you know where the pricing sits at today, there's not going to be that element of risk for them, or that longer-term element of risk. So from our point of view, and certainly my own views, compliance quote, these aren't the views of Crystal, Tandem, or Alexander & Co. I don't think there's going to be a significant change. I do think they're still going to be competitive. But even if we're looking at the marketplace now on the term loan stuff, there's not a huge difference from the very specialist lenders to the high street lenders, is there? So
if you look at if anybody's following Tandem at the moment, we haven't moved our tier 0. We've got a rate change coming soon. And for the first time ever, we're virtually going to feature number 1 in the Best Buy tables. And our very light adverse range now, Dan, is virtually touching the high street rates. And the high street lenders at the moment are quite happy going, look, we'll back off. Where the high street lenders are focused on at the moment, Dan, 90% of cases coming in to high street lenders is full advice. And where they're seeing the opportunity, Dan, is to take the product transfers from the broker directly in and cut you, the broker, out. That's where the focus on now is retention, not origination. And I think it's wrong. It's your customer. You hold the liability for that advice for 25, 35, 40 years. Your right should be that product transfer. And I think while you're focusing with all this huge volatility in the market, they're taking your lunch by taking your product transfer, which will be the biggest area of activity. And I don't think that's right, Dan.
no, it's absolutely not. It's absolutely not. But again, you're not at the forefront of most people's businesses. Neither are we. Again, the volumes that we do, there's still lenders out there which they don't have that respect to the brokers and the people that are putting food on their table, because ultimately you are just a cog in the machine and nothing more. So no, it's absolutely true. We got a question that came in previously. So this is off Eric Hughes. So thank you very much. Can a foreign national get a buy-to-let mortgage if they don't have their own residential and only arrived less than 1 year ago? In a nutshell, yes, they absolutely can. So they can be an expat or foreign national, obviously in the UK, residing outside the UK. Doesn't have to be a minimum income point of view, and it's all rate depends on the risk ultimately. So we run a risk rating, where that client's from, where that client is residing. But yeah, absolutely basic criteria on that is 25% deposit, can the rent service the loan, and making sure that you can open a UK bank account for the mortgage to be paid from and the rent to be paid into. It's as simple as that. We do lots of foreign nationals living in lots of different territories across the world. Caveat to this, if they've got Russian connections, we can't help for obvious reasons. But no, absolutely. So yeah, ultimately we can help any client realistically, as long as there's no sanctions against them, or they don't flag up on any international fraud checks, etc. And we've got the permissions as well to advise clients that are on UK soil, which the majority of advisors won't be able to. So hopefully that answers your questions. If we do have any more questions that are due to come in, can we please ask them, because we've got a couple of minutes left and then we'll be starting to wrap up. But we've looked at the past, we've looked at the present. Let's now look to ultimately predict the future and where H2 is going to take us. So let's look at, first and foremost, transaction levels and anything else that we feel is relevant within the marketplace and what people want to hear today. So Rog, what are your predictions for H2?
So where Tandem Bank is going in the broker intermediary side, we're first of all, we're blown away with the amount of deposits we have taken in. I think we've got somewhere roughly around the 3 billion mark now. We're very active in the motor car finance space, and we're the UK's leader in second charge mortgages. We're seeing a bigger than ever increase this month on our second charge deal flow. It really has surprised us. And then in the main charge resi space, because we do the legals in-house, so we have our own team. That's the team that basically registers the charges on the second charge division and pay off the unsecured debt. We now operate that on our first charge, Dan. And we're finding we're able to do completions for debt consolidation. So if you've got a customer today and they have got more going out than coming in, and the advice given is to debt consolidate and save them, say, £600 a month, we do a free valuation and it's free legals. And we have completed a case in 9 days and 3 hours. I think 3 hours is quite important. And the reason being is all you're doing is varying the charge from the current lender to Tandem. And when we issue the offer letter, we issue the mortgage deed as well. Dan, it's gone down so well, and we can go to 90%. A lot of the specialist lenders cap out at 85. We do 90, and that's to $500,000. And remember, Dan, we'll add the broker fee to the loan, which you get paid the same day as completion, and we don't charge interest on it. So it's looking at fair value, consumer duty, and where we think the market will move into a remortgage market later on this year, knowing that high rate fix is going to last for a while, Dan, and therefore people are going to be looking to try and build up a bit of a war chest for what's to come. John, what would you say?
It's interesting that you've taken that amount of deposits. I am seeing increasing amounts of people asking questions as part of inheritance tax planning and general planning in their lives. Why would they invest in other asset classes when they can get between 6 and 10% in savings? And when you kind of look at it like that, it makes a whole lot of sense. So there are definite people who are veering away from riskier transactions, property purchases, that kind of thing, and just putting it with the bank. I think there's going to be more of that as interest rates increase, and they will. They may taper off, but they will increase. You are going to find people being less transactional, saving more, I think.
And Dan?
Perfect. I think, personally, from a transaction point of view, I do think we're going to see an uplift in transactions in H2. I think the market's been, or the clients have been getting used to where the current rates are going. Because again, where we're at is relatively normal. It has been a bit of a freak show or a freak rate show since 2008, hasn't it? Which people are quick to forget where the rates were previously, but the newspapers and such don't help that either. So I do think transaction levels are going to pick up in H2 because ultimately more and more people are going to have no choice but to have to move or refinance or whatever that may be. But I do think we're going to see an uplift in transactions across the board. I also think we're going to see an uplift in terms of adverse credit as well. I think we haven't really seen the impact of the cost of living changes. I'm not going to use the word crisis because I hate that phrase, but the cost of living changes or increases. And again, if you go out during the week or at any point, you'll still see that the pubs are busy, the restaurants are busy, the shops are busy, and people aren't really taking notice of the fact that everything is increasing. So your food shop, your gas, your electricity. I think more and more people are going to have no savings left soon, because if you still look at what's held in accounts with the banks and building societies since COVID, people had built up relatively healthy savings balances, which are now currently getting eaten into. And I think we're going to see an increase in this short-term debt arrears because people don't understand the implications of, you know what, I'll just miss the credit card payment this month, but I'll catch up with it next month because I'm due a bonus, or I've got the holiday to pay for this month, or I need some new tyres, but I'm not going to cancel Sky or reduce Sky or stop my gym membership. I'm not interested in that. I'll just miss the Barclaycard payment because ultimately, what impact's that going to have on me? And we know it does have a significant impact with a lot of lenders, but then the very best lenders out there understand that these are just small blips and they're not serial offenders when it comes to payments. But I do think we're going to see an uplift in adverse credit, certainly when winter bites and people have to put the heating on again, which we don't have that sort of issue at the moment, do we? Okay. So yeah, quickly, last question that just came in. So Sanjita, thank you very much for this. Can you help a client remortgage if they plan to move abroad? In a nutshell, yes, we can do. We can look to refinance that to a buy-to-let. We can't keep it on a residential, but we can change it to a buy-to-let. We just need proof that they are actually going to move abroad and it's not going to be a backdoor residential. But yeah, we absolutely can. So if you want to pick up with us after, then please do. And that's it. That's it. So from me, I'll wrap up afterwards. But guys, do you want to just say your thank yous, goodbyes, and we will see you in 2 months.
Camilla, thank you for the lovely message you've just put on the questions and answers. And guys, thank you for the texts and the emails that we get during and afterwards. We try and, wherever possible, just have that collective shared experience, try and help you. What I do know, as a person who's lived through volatility and interest rates, this is becoming the new norm. More than ever, you are needed. with Consumer Duty coming, the banks now will literally pull away from advice. What you can try and do is, if you're constantly having to explain to customers about why interest rates are going up, why don't you record yourself on a video, put it on your website, send it out by WhatsApp or by some other form of communication. That way, you're not having to re-explain again and again. Your time is valuable. So if you're getting asked the same question, put it in some form of a video, some form of a document, and communicate with your customer at least once a month. Though with interest rates changing now, once a week. If you think because a customer's in a 4-year fix or a 5-year fix with 4 years to go, they're not worried, they are. And remember, the best time to send out newsletters of all the different things you can do is a Sunday morning at 10 o'clock. It's got the highest open rate. John, what's your wise words to finish off on?
Just a reminder that tax is possibly the biggest business cost a buy-to-let landlord has. And if they are worried about rates, they should also be worried about tax at the moment, because it will be costing them. So it's worthwhile having a chat and having a think about that. People always forget it. It's the last thing, it's at the bottom. But it is the biggest cost they will incur. Yeah,
no, absolutely. Thank you, John. And thank you, everybody. Roger's going to continue to reimagine the mortgage journey, I'm sure. John's going to continue to cast spells around taxation. But from my point of view, our business is just here to support and help you. We're all in this together. We've had a lot thrown at us over the past few years, but we get out the other side and we're as busy as we want to be. So any support, any help, anything at all that our business can support you with, please do. We've got the infrastructure and resources available to educate you, to help you, to show you how to find certain leads in certain areas. But we'll get through it. It's going to be an interesting few months. It's going to continue to be turbulent, but things will settle down eventually. But most importantly for me, thank you very much for taking the time out of your day. I know how busy you are to come on and listen to the three of us talk around the market, and hopefully you have found it useful. Thank you very much for the comments everyone sent in. It means a lot. We'll be back here in 2 months' time.
2 months.
2 months, John.
Or maybe Manchester, John.
Maybe
we could come in and do a bit of a questions and answers in the UK's leading specialist tax advisor in Manchester. Maybe that might be done, yeah?
Right, don't go on. People want to leave now.
They do. Take care, guys.
Cheers, everyone. Have a good one. Bye.